If you look at SoFi's recent earnings reports, you would think this stock is absolutely unstoppable. Record revenue, real printed GAAP profitability, millions of brand new users flooding in every single quarter. But then you pull up the stock chart and it tells a completely different story. The stock has been crushed, sitting roughly 30 to 34% down year to date from its late 2025 peak of $32.73. So what on earth are we missing here? Is the entire market wrong, or is there a hidden catalyst? One quiet fundamental shift that almost every retail investor is completely overlooking right now. Because over the next few minutes, we're going to break down the short seller attack that tanked this stock, the secret flywheel that could rocket it higher, the explosive chart pattern forming right now, and the exact price levels you need to watch before the July 29th earnings call changes everything. And real quick, if you find this breakdown valuable, do me a favor and smash that like button and subscribe. It genuinely helps the channel out, and it takes you 2 seconds. All right, let's get into it. Let's look at the actual numbers first. On one side, we have a company firing on all cylinders, posting a massive 134% year-over-year jump in GAAP net income and pushing its total member base to a record 14.7 million. But on the other side, the price action looks like a slow-motion car crash, plummeting all the way down to a $15 support zone earlier in the year. At first glance, this looks like a straightforward growth story going on a massive sale. A no-brainer, right? But there is one number, coming up in just a moment, that makes that easy conclusion a whole lot harder to defend. Here's where the story starts to get complicated, because that brutal sell-off was not just random market noise. In March of 2026, the short seller Muddy Waters dropped an absolute bombshell of a report, alleging what they called Enron-esque accounting irregularities. Specifically, they claimed SoFi had inflated its adjusted EBITDA by roughly 90%. Now, management vigorously denied all of it, but the reputational damage was already done, and it hammered the stock. Then add in a deeply concerning 27% year-over-year drop in their technology platform revenue after they lost a major client, plus a troubling uptick in personal loan charge-offs to 3.03%. Suddenly, the so-called future of banking started looking a lot more like a traditional, risky subprime lender. So is this the beginning of the end? Well, before you go and get too bearish, there is another layer to this that changes the entire picture. Despite that massive hit to their reputation, the underlying fundamentals actually tell a story of incredible resilience. What we are watching in real time is a company transitioning from a cash-burning startup into a structurally profitable financial institution. And here's the kicker. The macro environment is finally throwing them a lifeline. The cooler-than-expected June CPI data dramatically reduced the odds of Federal Reserve rate hikes, which delivered immediate relief to rate-sensitive fintech valuations. On top of that, they are aggressively rolling out high-margin products like the SoFi USD stablecoin and small business loans of up to $250,000 to keep that growth engine roaring. Which brings us to the single biggest question dividing Wall Street right now. SoFi is caught in a massive valuation tug-of-war. Think about it like this. On one side of the rope, if you value this company as a plain traditional bank, then a 10 to 15 times price-to-earnings ratio makes perfect sense. But on the other side, if this is a capital-light, rapidly scaling tech platform, then it deserves something closer to a 40 times multiple. Right now, SoFi trades at a premium forward PE of somewhere around 36.6 to 42.7. So here's the tension. If their tech revenue keeps sliding, that premium multiple is going to violently collapse. But if they can defend it, the upside is absolutely tremendous. And their primary weapon to defend that tech multiple just might be their single greatest hidden asset. This right here is what's called the Zero-CAC flywheel, and it is the engine that could quietly change everything. Here's how it works. When SoFi acquires a customer for something basic, like a simple checking account, they don't just stop there. Their cross-sell ratio is currently sitting at 43%. Let that sink in. That means nearly half of all their new products are being adopted by members they already have. And that drives their customer acquisition cost, or CAC, down to nearly zero on all those additional products. Think about how powerful that is. In a high interest rate world where competitors are forced to slash their marketing budgets, this internal ecosystem heavily insulates SoFi's bottom line from all that macro volatility. But SoFi isn't just relying on its current lineup to keep users hooked. What if they could buy their way into entirely new fortunes. Because that is exactly what they are doing. They recently acquired Composer Securities, an AI-driven platform that lets everyday retail traders build automated trading strategies using nothing but natural language. They also launched the SFYI Covered Call ETF, specifically designed to generate brand new streams of recurring fees. And here is the ultimate wild card, the one almost nobody is talking about. SoFi is officially listed in the SpaceX IPO prospectus as a potential retail broker. Just imagine that for a second. If that IPO actually materializes, it would trigger a massive, zero-cost flood of new retail accounts pouring directly into SoFi's ecosystem. Could one of the most anticipated IPOs in history quietly become SoFi's biggest growth accelerator? Fundamentally, the story is compelling. But let's see what the charts are actually screaming right now. Looking at the technical landscape, we are seeing some serious near-term structural repair. SoFi has successfully reclaimed its 20-day, its 50-day, and its 100-day simple moving averages. Momentum indicators, like the RSI, are sitting comfortably in neutral to bullish territory, somewhere between 54 and 59. And that matters because it means there is still plenty of room to run higher before this stock ever becomes overbought. However, let's be honest with ourselves. The broader macro downtrend is not broken yet. The 200-day moving average is sitting right above the current price, and it remains the final heavy resistance boss that SoFi has to defeat. And when we zoom all the way in on the daily chart, one very specific, very explosive pattern starts to emerge. Right now, SoFi is coiling up tightly inside a symmetrical triangle. This is a classic breakout pattern, and you can physically see the pressure building just below that heavy resistance. Picture a spring being wound tighter and tighter and tighter. The price is getting compressed into a smaller and smaller range. And history tells us that this exact kind of compression almost always comes right before a sudden, powerful, and highly directional breakout. The invalidation floor sits down near the $15.70 to $17.50 zone. But the upside targets? They point significantly higher. And there is one single piece of data that could turn a standard breakout into a full-blown violent rally. As of late June, the short interest on this stock sits at a staggering 188.1 million shares. That represents roughly 14.94% of the entire public float. That is an enormous bet placed against this company. But here's the thing about a bet that big. It also acts like a loaded spring. With average daily volume running around 75 million shares, the days to cover ratio comes out to 2.61. So what happens if this stock breaks out above resistance? It triggers forced short covering. Those short sellers get squeezed, forced to buy back shares to cut their losses. And that buying rapidly pours gasoline on the upward momentum. So the real question becomes, who is actually placing bets right now? And which side are they choosing? The smart money is completely and dramatically divided. On one side, institutions like STRS Ohio and Acorn Financial heavily dump their shares, slashing their holdings by over 89%. But then look at who's been aggressively accumulating. UBS, Goldman Sachs, and Cathie Wood's ARK Invest have all been buying this dip with conviction. And here's the detail that really jumps out. CEO Anthony Noto has personally bought over 130,000 shares in 2026. Just think about that. When a CEO drops millions of dollars of his own personal cash into his stock right in the middle of a short seller attack, that sends a loud and unmistakable signal of internal conviction. And Wall Street analysts are starting to take notice too. Right now, the broader consensus rating on SoFi is a hold, but the price targets tell a very, very different story. The average 12-month target sits between $22.56 and $22.78. That implies significant upside from the current $17 to $18 range. We are seeing genuinely mixed signals from the latest re-ratings. Goldman Sachs raised their target all the way to $21, while more skeptical firms like KBW are holding a cautious $17 target, citing near-term lending risks. So who's right? Well, we are about to find out, because this whole thing comes to a head with one massive catalyst just around the corner. Everything, and I mean everything, hinges on the July 29th earnings call. This is the crucible. For this stock to truly surge, we need to see stabilization in that technology platform revenue, because that is what defends the premium tech multiple. And for the longer term picture, you have to keep a very close eye on consumer credit defaults. If personal loan defaults breach 3.5%, the entire foundational banking thesis starts to crack. Management also needs to guide for a 38% EBITDA margin in the second half of the year to stay on track for their $1.6 billion full year target. So the pressure is on, which brings us to the one question every investor actually cares about. How do we trade this thing? For the mid-July setup, the direction is long, but listen closely because patience here is absolutely critical. Do not front-run this trade. What you want to see is a confirmed daily close or a high-volume intraday breakout above $18.50. Your strict stop loss should be placed just below $17.50 to protect your capital in case the stock loses its moving average support. If we do get that clean breakout, then target 1 sits at the upper trend line, right around $20.10, and target 2 is a highly strategic institutional level at $22.41. And here's why that specific number matters so much. That is the exact conversion price for SoFi's 2026 zero-coupon convertible notes. So the big players are watching that level like a hawk. And here is where the entire story finally comes together. Now, before we wrap up, a quick and important disclaimer. Everything shared in this video is for educational and informational purposes only. It is not financial advice. I am not your financial advisor, and I don't know your personal situation. Stocks carry real risk, and you can absolutely lose money. So please, always do your own research and consider speaking with a licensed financial professional before making any investment decisions. With all of that said, here is the strategic verdict. SoFi looks highly investable for risk-tolerant portfolios right now. The way I see it, the market has heavily overpenalized this stock based on short seller allegations that simply have not been substantiated by the company's SEC filings or its actual operating results. And yes, the standard fintech cash flow risks are absolutely real. We can't pretend otherwise. But their aggressive pivot toward capital-light, AI-driven fee revenue is directly attacking those very weaknesses. So by strictly managing your risk around that $17.50 support level, you give yourself the chance to capitalize on heavy short interest and extreme technical compression, right as this stock heads into a monster earnings catalyst. So now I want to hear from you. If SoFi's July 29th earnings show that technology revenue is stabilizing, do you think the short squeeze alone could send this stock ripping back above $22? Or are the credit default risks just too dangerous to ignore right now? Drop your honest take down in the comments below. I read every single one, and I would genuinely love to hear how you're playing this. And if this breakdown helped you see SoFi in a new light, go ahead and hit that like button and subscribe so you never miss the next deep dive. Thanks so much for watching, and I'll catch you in the next one.